While it's clear economic growth has slowed, the Federal Reserve is on edge, looking to hike short-term interest rates for the first time since 2006. Those rates have remained near zero since December 2008. And now low rates have helped stocks, but how much fuel is left in the rally, assuming the Fed tightens later this year? Let's ask Scott Wren, Senior Global Equity Strategist at Wells Fargo Investment Institute. And Scott, in its April statement on Wednesday, the Fed didn't give any details of a rate hike timing, but given the weak GDP for the first quarter, when do you think they'll raise rates? I mean, isn't a June rate hike off the table?
I would say absolutely that a June rate hike is off the table. We have been leaning towards September, and I would say really some of the data, you could easily make the argument that the Fed really doesn't need to do anything this year, but I think there's a reasonable chance you'll see a very small change to interest rate policy in September. But the Fed just wants to get the ball rolling on the normalization of rates. So I think they'll do something, but it's not going to be much.
Yeah, and this morning, the PCE deflator, which is the Fed's preferred inflation gauge, was released. That rose 0.1% on the core level in March, missing expectations of 0.2%. So it seems like the Fed has an inflation problem as well, right?
I think they do, and really when you look at PCE and you look at, and year over year it was about 1.4%, it's tough to get that number from 1.4, 1.3 or 4 up to 2%. I mean, it may sound like it's close, but it's really not, and certainly that number has not been moving in the direction that the Fed wants to see it. So they definitely have an inflation problem.
All right, and for investors, how do you factor in the Fed? It would seem like a delayed rate hike would be good for stocks, right?
I think it would, and you've seen a lot of times over the last year where when bad economic news comes out or when economic news comes out that misses expectations, the market rallies on that, and that's certainly purely due to the thought that, hey, the Fed's not going to be so quick with raising rates. I think what the Fed is going to do 3 or 4 months in advance is they are really going to lay it out. They are going to give us very strong hints. We're going to know exactly when that initial rate hike's going to occur, but then we're also going to know following that, what's the speed and magnitude. That's the most important part of this whole equation. So I think the Fed's going to prep the market. They're going to prep the market well in advance, and there will be no question as to when that first hike occurs. They didn't say anything about it yesterday, and I think that probably the next meeting they'll start to hint at it, or possibly the meeting after that.
Yeah, all right, so give us your playbook for May. I mean, what should investors know?
Well, I think for May, what you need to think about is the earnings season that we're hearing now, the first quarter earnings season. Earnings are a lagging indicator. That's in the past. What you need to do is look forward. I think you're going to come out of the year with about a 2.8% GDP. If we see more volatility based on these earnings, those are buying opportunities. We want our clients stepping in on down days and down weeks. We want them buying technology, industrials, consumer discretionary stocks, stocks in sectors that are sensitive to the ebb and flow of the economy. You're seeing better news. You're going to see better growth news out of the U.S. this year. You're going to see stabilization and better news abroad. This stock rally has more to go.
All right, Scott Wren from Wells Fargo Investment Institute, thanks very much for your time.
All right, thank you.
I'm Scott Gamm, and you're watching The Street.